to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and we're going to be talking about money. We're going to be talking about inflation. Inflation is here to stay, and some people are predicting a recession. We're going to talk about that. Why, and what do you do? If you've been listening to the program, you know that there have been major themes we've been talking about for a long time. From 2010, I started talking about Dow 100,000, at the time, and the secular bull market. You know, we had started a secular bull market, and at the time I began to talk about Dow 100,000, the market was at 10,193. It had arisen already from 6,000, but at 10,000 seemed a long way away. It doesn't seem so far away now. I talked about the super cycle beginning in February of 2012. What drives the secular bull market? The Dow was at 12,862. And in 2016, I started talking about what would end the secular bull market. 2016, the Dow was at 20,914. I said clients need to prepare, not for another great recession, but the high probability was inflation. And here we are today. And our prediction is that inflation is going to continue for some time. What do you do? We're going to be talking about that as we come to the program. But I want to take a diversion right now and talk about something that's going on, an event that's happening April 29th, has nothing to do with making money. It has everything to do with music programs in schools. Music education in public schools is in desperate need of funding, and that's where Music Aid Northwest has stepped in to offer grants based on need to kindergarten to 12th grade music programs. And they're entirely funded by Music Matter specialty license plates and from Play It Forward Gala, which is happening April 29th at the Triple Door in Seattle. Tickets, $250 and $500. An exceptional deal, an exceptional program to help. Because for many programs, I can tell you, when we lived on Mercer Island and our kids were in school on Mercer Island and going to Overlake School, if there was a shortage in any program, like the music program, parents would step up and write a check, no problem. But for the kids living in Ritzville or Omak or Union or some of the small cities around in Yelm, the parents don't have the funds to step up and write the funds. That is what Music Aid Northwest is doing. And over the years, over the last few years, we've raised just under $1 million. The average size grant is less than $5,000, but it's for teachers who are buying new used instruments, for example, or ukuleles, or some other thing that's needed in those music programs where the funding doesn't exist. So, all that to say, you should consider coming to the gala on April the 29th. Tickets are $250 and $500. You can email me at Mike at Adams Financial Concepts, and I'll get you set up with all the information you need. Triple Door. It's going to be Sway, who's going to be the major band. I've been to a lot of galas in my lifetime. This is by far the very best one. So,
and I was there last year, Mike. It was fun. It is a good time.
It is a great time. A really great time.
You got to watch Mike play air guitar at the end.
It's funny. The guitar's not hooked up to anything.
Yeah. Make some of those guys who donate a lot to feel good about themselves up there on the stage. But it was fun. It was a really good time.
Yes, indeed. So let's talk about what's going on and what do you do with inflation and what's the forecast and what things are going on. And I want to tell you, when I started my career, my first professional job was at Pacific Gas and Electric down in San Francisco. I was I majored in mathematics undergraduate. I got my MBA at Carnegie Mellon, but even before I got to Carnegie Mellon, after I graduated from Oregon State with a degree in math, I ended up at Pacific Gas Electric in their operations research department. And this was something that was really new at the time. 1965, computers were just coming into existence, and the computer at Pacific Gas Electric was the size of a room. It was huge. Had less computing power than you have in your cell phone today, but at that time it was a huge deal. And people were beginning to utilize computers to analyze a whole bunch of data. A lot of data, because now you had a computer that could massage data in huge quantities. And people were beginning to look at different correlations and factors of what was going on in different places. Now, the Operations Research Department, which had been renamed, had been the forecasting department. And the idea was to forecast electrical consumption going into the future. And they did that every year. It's something you see today that the airplane manufacturers are doing, the oil manufacturers are doing, and the electric utilities do. It's important for an electrical utility to know what demand is going to be in the future, because if you build too little and you have too little capacity, you end up with brownouts or blackouts. If you build too much, you end up building overcapacity and having a lot of capacity which is underutilized and for which you don't get any revs. So forecasting is an important part of a utility. And the old way of doing it was to sit down and take out last year's book and count the number of dividers in the book, go get new dividers, exactly the same number, and essentially duplicate what had been done the year before with an extra year's worth of data. But now with computers, you could do correlations and you could look at all the factors which could refine what electrical consumption was. And we were having fun doing it. It was exciting, it was new, it was something that hadn't been done before. And we were doing linear correlations, plugging in variables to see what predicted electrical consumption growth or declines if it happened to decline, which it did, but to see how we could predict electric consumption. And so we plugged in everything you could think of, crazy things. And you know what we found? There was one predictor that was 97 or 98% accurate. That's really, really, really significant. 97 or 98% accurate. You know what it was?
No idea.
The number of prisoners on Alcatraz.
The number of what?
Of prisoners on Alcatraz.
You're going to have to explain that.
As the number of prisoners increased on Alcatraz, the amount of electricity consumed went up. And it was a straight line correlation.
Just on
that was
Alcatraz?
Perfect. Just on Alcatraz.
But
Do you know what that really meant?
No.
Is when they shut down Alcatraz, electrical consumption should go to zero. And what that really taught me is there has to be a causal factor for what's going on. It's not enough just to find a correlation. There has to be a reason behind that correlation. And so that brings me to the inverted yield curve. You've heard it said, people have said, you hear it in the news all the time, you hear it on CNBC, you read it in Barron's, you read it in any number of news articles, that the inverted yield curve always results in a recession. Now remember, when the number of prisoners on Alcatraz increased, it always meant electrical consumption went up, always, until it didn't. So I want to talk about what the curve is, how it gets inverted, and why people say it always results in a recession. So normally when you have a yield curve, it starts in the bottom left-hand corner and goes to the upper right-hand corner. It starts with short-term rates being less than long-term rates. And when you think about it, it's completely logical that that happens, because when you're buying a short-term bond, you're getting today's interest rate. When you're buying a long-term bond, what you're getting is today's interest rate with an allowance for the inflation that's going to happen between now and the time that the bond matures. So you'd expect interest rates in 10-year bonds or 30-year bonds to be greater than interest rates on short-term bonds, because you're getting compensated for the inflation risk. That's how it normally works. That's what the normal yield curve looks like. But when you look at interest rates themselves, short-term rates are really controlled in the United States by the Federal Reserve. In other countries, by the central banks. The Federal Reserve deals with Fed funds rate, and that's the rate that banks charge each other for loaning each other money. The Fed charges banks for loaning money. That's the rate the Fed controls. And they set it. They have a Fed meeting, and you know that all the news broadcast the Fed has raised interest rates 0.5%. That's all short-term, 0.5%, 0.75%, 0.25%. Or at other times, they've lowered that rate. The Fed has a huge amount of control over short-term rates. But over long-term rates, that's the market. The Fed has very little control over what's happening on long-term rates. So how are they determined? How are long-term rates determined? Well, we're coming to commercial break, and we'll have to wait until after the commercial break to talk about long-term rates, and we'll have to talk about how does that curve get inverted so that short-term rates are higher than long-term rates. Don't go away. We've got a lot to discover. What do you do if inflation continues for a decade?
About money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So I've been talking mostly, about
Mike likes to talk.
I like to talk, and I've got a lot of stories to tell. So been talking about the yield curve and the inversion of the yield curve. Haven't gotten to the inversion of the yield curve yet, but talking about how the yield curve operates. Talked about short-term rates are controlled by the Federal Reserve. So, and usually they're lower than long-term rates. Long-term rates are set by the market. It's what people are willing to pay. And every week or every couple weeks or every month, the Federal Reserve or the Department of the Treasury holds an auction in which they auction off bonds. It could be short-term bonds, it could be medium-term bonds, it could be long-term bonds. And the banks and institutions come and they bid what price they're willing to pay for those bonds. And foreign governments get to bid in it. A lot of people get to bid on those bonds and they get to trade them afterwards as well. But that really sets what the price is for long-term rates. It's set by the market, not by the Federal Reserve. So the Federal Reserve can jack up short-term rates or lower short-term rates, but it has a very limited effect on what's happening on the long-term rates. So coming back, normally long-term rates are higher than short-term rates because people are anticipating to get paid for the risk of additional inflation, so that's why long-term rates are higher. But what happens when you have an inverted yield curve? What that means is the demand for those long-term bonds has gone up. The demand for those bonds has gone up above and drives the rates below what the short-term rates are. There's a thing called a flight to quality. It happens when people expect a recession or a depression or some geopolitical upset. What you have is a lot of institutions that own both bonds and stocks will sell the stocks expecting the stock market to go down, and they want to buy bonds which are more stable so that when the stock market begins to recover, they can sell the bonds and buy stocks. So you have a flight to quality. It happens when people expect a recession because they expect stocks to go down. So they think by holding the bonds, they'll maintain their capital and they can reinvest in the stocks when the stocks are lower. It can happen when there's a geopolitical event. It can happen when there's an invasion of Ukraine because that is unsettling to the world. And that involves not only institutions, but it involves central banks as well because central banks have their reserves and the U.S. Treasury is considered the safest, most traded. It trades 24/7, 24 hours a day, 7 days a week, constantly. And it's a currency that central banks use. That's how they build their reserves. They hold a lot of treasuries. Japan, China, many countries hold U.S. treasuries as part of their reserves. So the flight to quality generally ends up when people are afraid or when people are predicting bad times or people are actually living in bad times. So it really is a factor that we're living in a time in which, and you hear it predicted by economists, you hear it predicted by market pundits, you hear it predicted by the CEOs of companies, that we expect a recession.
Bond king Jeffrey Gundlach came out and predicted his recession this morning, saying that he's buying treasuries. He's flight to quality.
It's exactly that.
If you don't know who he is, he managed a company called Double Line Capital, and he's got about $100 billion in bond mutual funds and EFTs that he builds for institutions.
And flight to quality. Buy bonds, wait for the stock market to go down. Something very strange happened in October. Instead of seeing a recession happening, the market started going up. It's something we've talked about, is that Renshaw did his study saying that if the market after 90 days has recovered a third of what it dropped, the market is on its way to a recovery, not on its way to a recession. So now we have two conflicting. But then I want to add one other thing in which you hear an awful lot about. And to understand it, we have to go back to October 16th, 1987, the Friday before Black Monday, 1987. There was a money manager by the name of Marty Zweig who for his clients put 2% of their money into puts. Those are options which you expect to be able to put today's price to somebody when the price has gone a lot lower. And so on that Friday, seeing weakness in the market, he put 2% of his clients' portfolios into puts. And of course, on Monday, the market dropped over 30%. And his clients not only maintained their capital, they made a huge amount of money. And and he became one of the gurus on Wall Street. And his phrase was, don't fight the Fed. He coined that phrase, don't fight the Fed. You hear it today. People say, don't fight the Fed. That all came about because of that Friday purchase of those puts. Now, if you look at his long-term record, if you take out Monday, October 19th, his record was not that great. But for that one day, he had an incredible return for his clients.
But that's all it takes.
That's all it took.
I mean, it's like hitting a home run and grand slam in the ninth inning with the game tied. It doesn't matter what you do after.
Doesn't matter. That was, the Cal Raleigh of the... But that led to this whole concept of don't fight the Fed. When the Fed is raising interest rates, of course there's going to be a recession. The yield curve's inverted, of course there's going to be a recession. Number of prisoners on Alcatraz is increasing, of course electrical consumption is going to go up. Until it doesn't. Until none of those things happen. And we talk all the time. The things that have never happened before happen all the time.
I think the other thing, though, bring up the Fed's $9 trillion balance. I think one of the big matzo balls hanging out there that we don't really know what's going to happen. We've never been in this position before.
We never have.
In 2000, after we started doing this after the Great Recession.
Yeah.
But before the Great Recession, the Fed's balance sheet was $800 billion, and now it's $9 trillion. In 2015, it was $4.5 trillion, and now it's $9 trillion.
And the Fed is unwinding it. $95 billion per month is what they intend. And so far, they've unwound about $500 billion. And every month, another $100 billion or $95 billion is flowing in. But the question is, will that continue? Can it continue? So if you look at what the $9 trillion is made up of, $2 trillion are bank reserves. Or right now, $2 trillion. Almost $3 trillion was bank reserves when it was $9 trillion. You have, in addition, treasuries, and you have other bonds that the Fed holds. And once they begin to drop, the easiest part is to reduce the reserves because banks are flush with cash. Banks have a lot of cash. Mm-hmm. That's something which you don't find usually when the Fed is raising interest rates. Banks generally don't have a lot of cash. And so what that does to banks is it means they quit loaning money. Right now, they're flooded with cash. Some of the small banks, after the Fed has begun to reduce, are having some problems.
Yeah, but my friends, real estate, some of the banks are pulling back. If you don't have, if you're not AAA credit on your project, some people having a hard time getting.
They are, and they're raising their interest rates to people. And they're doing that in anticipation that the Fed is really reducing reserves. Mm-hmm. And if you look at it, they'll reduce the reserves almost 2/3 as the first step in reducing their balance sheet. So what that does is it puts a squeeze on all the banks. And it's intentionally done to slow down loans to banks and to restrict the economy.
Right, and we've talked about this before. So restrictions in the money supply. Milton Friedman built his whole career on the restriction of the money supply. Talking about right before the Great Depression, the argument was between industrial output versus monetary policy, and the Fed reduced rates in 27, 28, and 29, and then again in 33 caused a lot of the problem, exacerbating a lot of the problem we have. Mm-hmm. And I don't know if we're seeing some of that.
I don't know. The question is, can they really reduce their balance sheet without really upsetting the economy?
And why they're raising interest rates.
Yeah. So, it's not a foregone conclusion that the inverted yield curve will not do a recession. But on the other hand, the Fed is working to reduce, but it's not working at this, or not working to any great extent. And we've talked about some of the reasons. But coming back, the Fed has started with $3 trillion worth of bank reserves. They're going to reduce that. What happens when we get down to $1 trillion is a really big question. They have $2 trillion of reverse repos. Those are the things that the banks held to guarantee the big institutional investors who didn't fall under FAC. And then they have another $2 trillion in miscellaneous bonds.
I think some of those are corporate bonds. I saw that they were buying corporate bonds. Yeah.
So hang on, we'll come back and revisit this right after the commercial break.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So we've been talking about the inverted yield curve. We've been talking about don't fight the Fed. We've been talking about the Fed itself and the unbalancing or the liquidation of their balance sheet, because they are liquidating $95 billion every month. The idea is to reduce the $9 trillion. Of the $9 trillion, $3 trillion is in bank reserves or was in bank reserves. $2 trillion was in reverse repos type bonds, those toxic bonds everybody talked about during the Great Recession. And the remainder is in corporate bonds and miscellaneous other holdings that they went and purchased to push up the economy. So when you're reducing bank reserves, that's the very easiest thing to reduce because the banks have been flush with cash. And yeah, they're beginning to draw back some, as Al pointed out, but they've still got a lot of cash. And until the reserves get down to $1.5 or $1 trillion, it's not really going to put a squeeze on the banks. What happens then? Once they start to dump and once they start to get rid of the reverse repos and the corporate bonds, now you're dumping bonds into the market. Those are long-term bonds. And suddenly you've got a seller into the market that's selling $6 trillion worth of long-term bonds. And they're not all long-term, some are shorter term, but suddenly you've got a huge seller and the market knows there's a huge seller. So what does that do to the curve? Does it mean the curve begins to uninvert, not due to a recession, but simply due to the fact the Fed is unleveraging their balance sheet? You know, if you look at it, it's only $1 trillion per year, a little over $1 trillion per year. So they've got 6 years to go to get that undone. But will it put the bonds and the curve back to a normal uninverted yield curve without a recession, but just because you have a huge seller of bond? I mean, the question is, can they do it? And can they do it in such a way that it really doesn't damage the economy as well? Because essentially they're removing liquidity from the system as well. For every dollar the Fed drops out, it's unprinting money. During the Great Recession, during the dot-com bust, when the Fed was buying or was printing money, they were adding to their balance sheet. What happens when they subtract from the balance sheet? That's unprinting money. We've only been in a very limited number of cases where that's happened. So that's overhanging what's going on. That could in itself push long-term interest rates up, which could in fact begin to push up inflation as well. We have in the worldwide situation something that adds to this whole picture, and that's China. There are right now 38 countries in the world. Of all the world countries, I forget, what is it, 200? There's 38 countries whose economies are in crisis situations. And those countries are going to not meet their debt payments. They're not going to be able to meet their debt obligations. And what was established in the 1950s for countries that were in a crisis situation? The International Monetary Fund was set up and the World Bank was set up. Both of those were set up to help countries that were in financial crisis, because the crisis tends to move country to country, and if one country defaults, another country, it's like a set of dominoes. One domino begins to fall and others begin to fall. And so the International Monetary Fund was set up and the World Bank was set up to become lenders to countries in crisis. And what those organizations do is they go to a country, and we saw this almost every day for months on end when Greece was in financial crisis, where the concern was it was going to bring down the European Union, and that was going to put the world into another deep Great Recession, or even worse. And the International Monetary Fund came in, the World Bank came in, and the idea is those organizations work with countries in crisis to help them reduce government payments, to reduce government obligations, and in many cases to restructure their debt, and in some cases to actually give debt holders a haircut in order to make the country financially not strong, stable. That was the purpose of the International Monetary Fund and the World Bank. The question that comes up now is, of those 38 countries, in half those countries, China is the biggest lender. And not China the government, but China through giving money to Chinese companies to finance it. I've talked before about Hambantota. Hambantota is a port in Sri Lanka. It was the second largest port in Sri Lanka. The Chinese came in because Sri Lanka felt that to boost their economy, it would be a good deal to rejuvenate Hambantota and make it into a stronger, better port. And China was more than willing to loan the money through Chinese companies to redo the Hambantota port. They used Chinese labor. They used a lot of Chinese companies to do the rejuvenation, and China financed the whole indirectly through companies. And when it came time, when the bonds matured for Hambantota, Sri Lanka didn't have the money to pay off those bonds. And so Chinese companies repaid repossessed the port. A quarter of the Chinese Navy now is anchored in Hambantota. They essentially own that port. They own it through Chinese companies which they control. So that's an example of where we're headed with half of the countries that are in financial crisis. The International Monetary Fund and the World Bank have criteria that they set up for how to bail out a country, how to bail them out of a bankruptcy, how to bail them out of a crisis. And those things are set, and those rules were redone in 2020 along with COVID to allow countries to work themselves out of. China doesn't agree. China does not want to go by the rules. China wants to set their own rules.
So if they're not going to, we talked about this a couple weeks ago, if they're not going to write down the debt of those countries, they just want to repossess and seize the asset?
Seize the assets.
I mean, you talked about, the Greece. Remember when Greece, Spain, Portugal, and Italy were in terrible crisis? And we did a show a while back talking about China, how they own 20 ports. And they have interest, partial ownership of 20 ports in Europe. They own the one in Greece out.
Yeah.
One of the largest, I think it's the largest port in Greece. They've owned it out.
They want to do that in a lot of places. Just simply own the assets. The issue is that doesn't sit well with the G20. Doesn't sit well with a lot of other countries. Most of the time, most of the debt in Greece, for example, except for a few specific places, most of the debt was government debt, and it was governments that bailed them out. They had sovereign debt, which they couldn't pay, and so it was the government. The U.S. government wrote down some debt, England wrote down some debt, France wrote down some debt. They wrote off interest and so on.
Right.
China now is in a situation where they've loaned the money oftentimes through private companies. And by doing it through private companies, the private companies don't want to write down debt, and China doesn't write down debt. And so China has created a situation where these countries that are in crisis are having a difficult time getting through. Take Pakistan. Pakistan has $287 billion of debt that they need to refinance. They only meet the international monetary criteria for $1 billion out of $287 billion. So what is Pakistan doing? They're hoping that China will come through and loan them money to refinance. What is China doing? China probably wants to own a big chunk of Pakistan. You get to see the difference.
Well,
Russia invaded the Ukraine and sent the army in. China seems to be a lot smarter. They just loan the money and then repossess the country.
Yeah, I know they're squeezing a lot of African countries.
Yep.
I know that when we did our program talking about China, that they reroute a lot of we talk about seeing these spy balloons going over recently.
Yep.
And we talk about what they were doing, and they were running a lot of their data. They'd run through data centers in Africa. The information would be shipped off to China so they could, disseminate where it was all going through a little misdirection to the U.S.
So it creates a very interesting situation because, on the other hand, what happens if those countries just simply nationalize the Chinese? Anyway,
yeah,
it's creating a national debt issue, which complicates the U.S. debt issue, which complicates inflation.
And we're going to have a debt issue here in another 6 months, right? We're going to be fighting for our debt ceiling.
So we're coming to commercial break. Don't go away. We want to wrap this up. What do you do?
So, Mike, we're talking about China. We're talking about debt. We've been talking about the Federal Reserve, inflation. One thing we've left out of this, and we touched on China when they're loaning money, and we haven't gotten to them, opening their economy again, which would be a huge boost to things going forward. But we left out the American consumer. 2/3 of GDP is consumer spending.
It is. And
the largest retailer in the world came out this week, Walmart, saying that they don't expect in the second quarter, they don't expect the consumer to hold up. They see a full year company expects a decline between 11 and 13%. So, I mean, we got, people like Gunlatch, we got people telling us about recession, and then we got Walmart coming out saying we don't think the consumer is going to hold up.
It's an interesting question because Kraft Heinz has said that they will not raise prices anymore. But what we're seeing is something that we have never seen before, is we're seeing people move from job to job to job. 47 million Americans quit their jobs and moved on last year. Mm-hmm. I've talked to several people that are talking. They put out an advertisement. They get dozens of people to apply. They set up interviews. They talk to the people on the phone. They do a little bit of a background check on the phone. The people set up a time for an interview. And then half of the people that have scheduled interviews ghost them. They never show. Mm-hmm. And not only do they not show, they don't even say, I'm not coming in.
Mm-hmm.
5 years ago, if somebody scheduled an interview and didn't show up, it was a big deal. Today, half the people don't show up. And even the half that show up, if somebody takes a little bit of time before you can make a job offer, the people have already accepted somewhere else. And if you look at some of the resumes that are coming through, the people work 3 months for one company and then 4 months for another company. And then they're applying for a job, again, another job.
The American consumer has been quite resilient for a while. Will they continue to be resilient? Will that resilience hold up?
It's really hard to know. My gut feeling is seeing that wages are increasing at the rate of inflation and maybe even a little more than the rate of inflation. They have the money to consume. And we went through a period of time through COVID when people were receiving those $1,200 checks and receiving checks. When we saw the people, they didn't have things to spend it on. The restaurants were closed. The theaters were closed. So they were paying off their credit cards. And they couldn't buy cars. They were buying used cars. They were buying refrigerators. And they were buying household things. As they completely finished doing all of that, they're going out to restaurants more. We're seeing a shift in what they're buying. Mm-hmm. You can only buy X number of cars. Actually, you can buy more cars than there are some that want more cars.
Yeah.
But for most people, once you have a couple new cars, you're not in the market for cars for 5 or 10 years or whatever it happens to be. Once you have a new refrigerator, a new dishwasher, once you have those things, you're not in the market for those.
Right. So you think the service sector is going to hold up the economy? I think people are going to spend on services.
I think they're going to spend on services. They're going to spend on recreation. They're going to spend on travel. If you look at the cruise lines, they're seeing record number of billings that are higher than they saw in 2019. If you look at the airlines, they're experiencing.
And we're still seeing housing prices, especially around here in Seattle, still going up. We still have a shortage of housing. We don't have enough housing.
So I think we're seeing shifts happen in the economy for a number of months, maybe a couple of years. Car prices were going off the chart. Mm-hmm. I mean, the way you got a new car is you would go in and go through the models online, put a deposit down, and 6 months later a car would be delivered. Used cars, prices went through the ceiling. And then a few months ago, sales dropped off a cliff because the people that needed a car, wanted a car, that had bought a car, had already done their shopping and purchased. Mm-hmm. And once everybody's got their new car, the number of new sales takes a big drop. I think we saw that with household items. And that doesn't mean that people have run out of money. It means the money they have is shifted to other places. Go to most restaurants today. They're packed. The airport's full of people. And most of those people are not waiting for canceled flights or there because of canceled flights. That's happening too. But I mean, people are doing the vacation they didn't get to do in 2020 and 2001.
So you're seeing a shift. You're saying we're seeing a shift in the economy, that people aren't necessarily pulling back, that they've bought everything they're going to buy.
The big items.
And they're going to spend on services, spend on travel, spend on those type of things.
So, I mean, you never know for sure.
Yeah. No, only time will tell.
Only time will tell.
Yeah.
It's Jamie Dimon has talked about it with Chase. They're not seeing the consumer spending less. Where they're spending has changed.
Yeah, because he came out and remember he was a dour out last year. He was sour on the economy, terrible. Yep. And he came out earlier this year and said he thinks he was wrong. He doesn't think it's going to be as hot as a landing as he thought.
I mean, things that have never happened before happen all the time. And as long as people are spending money, we're not going to see the recession that people see.
No, and if we do get the Chinese economy, if it does open back up and they do start consuming, that's going to be a real boost to the world economy.
And as we get the war over in Ukraine,
that's when nobody knows when that's not
going to.
Doesn't look like it's going to end anytime soon.
Probably not.
I think we're in for that one for a while.
But that too will settle.
And then we know this. I don't like his politics, Erdogan's politics of trying to play his country off as being rebuilt, but it still does need to be rebuilt after those terrible roofs.
Yeah,
a couple weeks.
Yep. So lots of things going on. A lot of unsettling. But the reality is there's opportunity there, being at the right place at the right time.
We haven't even got into talking about technology and AI and where the new growth is.
That's true. So much to do. Hopefully you understand the inverted yield curve. You understand better why not to fight the Fed. You understand understand how those phrases came about and why things that have never happened before happen all the time. You have to be prepared. So have a very good week, a very good weekend, and we will be back next week to talk about money. Join us. If you've missed this program or you missed any of the other programs, you can find us on About Money by logging into YouTube. You can find programs on our podcast, on our website. And if you have a portfolio that you think needs adjustment, let us know. We can do a good deal on that too. We'll be back next week.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today, or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.